Well, g'day traders. My name is Chris Weston. I'm head of research here at Pepperstone. And after a 4-week hiatus, we're back with As Good as Gold. So we're going to be looking at the rates market. We're going to be looking at fixed income more broadly, look at the relationship that precious metals have with those sort of commonalities there. Have a look at the US dollar, have a look at currency markets in some depth. And obviously, if we go into some broad commodity themes as well, which I think is so important. There's so many great opportunities that are playing out. And I think as we go into 2022, this idea of don't fight the Fed is the classic investment mantra that's been going through the markets for the last 5 or so years, or probably even further back to the Bernanke era. And if we're thinking about that now, we're obviously going into 2022 with the market fully focused on quantitative easing, balance sheet reduction. Probably happens from around July, with the Federal Reserve allowing that balance sheet to contract or run off by about 25 billion initially, and then those caps should go up to about 75 billion in terms of the balance sheet. And I think if they maintain that going forward for the next 2 years without any major hiccups, big if, of course, then they can reduce their balance sheet quite nicely over the next couple of years. Obviously, not completely eradicate it, but they'll take a big chunk out of that at a time when they're raising rates. And they may not do it concurrently, but of course, that's where we are at the moment, with the Federal Reserve potentially raising rates 3 times throughout this year. At least that's what the market's anticipating amid quantitative tightening. This idea of not fighting the Fed means taking a much more active approach to our trading, a much more active approach and two-way approach to investing as well. I think you're going to see funds coming out of passive funds and more into active style forms of management. But it does mean that the chasing alpha, chasing returns are going to be harder for people who have just been sitting on their hands for the last couple of years and just riding that bullish trend going forward. So let's have a look at the markets and let's assess what we're seeing at this kind of juncture at the moment. And I probably want to start really just by having a look at the calendar, just having a look at what we're doing. So I'm saying this before the US CPI numbers come out. Now, the interesting thing for people who are watching this video at this point is kind of this probability distribution that we have as traders, and we're trying to understand what is priced at the moment, what could happen on the different permutations of outcomes. Now, the one we're looking at obviously is headline CPI 7%, and then if you look at core, the market's expecting that to increase 50 basis points to 5.4%. For me, what I feel when I'm looking at the dollar and how that feeds into the gold price, all these factors, is what is the market wanting? And I think the market wants a weaker dollar at the moment. These big consensus trades that we had for 2022 are being blown out the water one by one. In fact, that's something that you're so used to year after year. We go into a year, the market thinking, oh, this is going to happen. And at the moment, it's a stronger US dollar. And that's just being unwound. People look at consensus trades, and it just within as soon as the year starts, these consensus trades unwound very, very quickly indeed. And I think if we get a number, I ask myself, if we get a number, say 5.2% on core, are we going to see a much bigger downside move in the US dollar if we were to get say a 5.6% move? And what would the upside move be? So I think the downside is potentially much greater if we get a miss than the upside would be in the dollar if we get a beat, for example. So I think the market wants a weaker US dollar. But that CPI number obviously going to be very, very interesting indeed. We've got retail sales at numbers at the end of the week. That could be a bit of a market mover, along with some small sort of nuance that comes through these university 1 to 5 year inflation expectations. We go through the sort of calendar. The Fed meeting, obviously, on the 27th is going to be an absolute blockbuster there. Again, the Fed market's very, very, very focused on this quantitative easing situation. How much of that is now being discussed? How much of that is being priced? We can have a look at rates pricing in a moment, so I think it's absolutely key. I want to also have a look at what's happening in ISM manufacturing. I think equity returns are going to be driven by what we're going to be seeing in manufacturing. Take a step back. This number here, the employment cost index that comes out on the 29th, the Fed have made reference to that a couple of times. I think that's going to be a big market driver for us to look at in the short term as well. Now, in terms of ranking, let's have a look at what's been happening over the last 5 days and how that's influenced the gold market. We are seeing those dollar outflows playing through, and you can see over the last 5 days, these high beta names, the Brazilian real, the South African rand, they've been working quite nicely there. These petro currencies, the CAD, the MEX, the NOK, working beautifully at the moment. I'm just going to flip over quickly to have a look at this chart that we've got on crude, because crude is absolutely ripping at the moment. 81.39. You can see this bullish trend at the moment. It just holds these short-term moving averages. I've got a 5 and a 9-day exponential moving average here, just to show that whenever price sort of seems to move lower, we're getting support. The buyers are supporting into there. We've got this really big bid that's come through in the market. Excuse me. And I think this is really important, not just for momentum traders who are working off longer time frames like daily charts, but for people who are scalping within those time frames. They're momentum scalpers. if you're taking this down to a 15, 30-minute chart, you've got the daily candle, which is really strong in range expansion, and you can scalp quite nicely within that at the moment. But of course, everyone's now focused on whether we can get back up to $86 in crude, and potentially if we were to break that, do we start talking about $100 again? But in this environment where we're seeing higher crude, it's supporting inflation expectations, and that's keeping real rates fairly suppressed at the moment, which I think is obviously so important for gold. So for me, crude is absolutely essential for what's going on. But we saw that in the commodity flows that we just talked about, the commodity currency flows that we've just been seeing there. But the dollar is getting a bit of a wriggle on. Of course, this was the big consensus trade for 2020. Go long the dollar. The Fed are tightening and the Fed are normalizing. Their balance sheet's going to run off faster than any other market. We're getting these yield differentials which are working. But let's have a look at that dollar price at the moment, because we can go into these currencies there. We obviously saw what's happening in the petro currencies, but let's have a look at that dollar call. The dollar index here with obviously 57% weighted towards euro dollars, right end at the bottom end of the range. It's through the 50-day moving average, which I can put on here there. Generally we use the 50-day as a sort of a trend filter, and it's now below that level, a high level trend filter. But you can see the short-term moving averages now are sort of moving lower. If we take out this bottom end of the range at 95.50, I think the gold price is going to have a nice move higher and continue, especially if you're looking at it priced in dollars. If you want to be long a gold price, my advice is to try and look at gold in the weakest currency. We offer it in multiple different currencies: the yen, the pound, the euro, the Swissy, and a couple of and euro as well. So we want to be long gold in the weakest currency. And if the euro is going to break down here, we want to look at XAU USD. Of course, on the other side of the situation, if we want to be short gold, we want to be short gold in the strongest currency. So obviously you need to make a perception of what's happening there. But this is a setup that everyone needs to have on their radar. If this dollar index breaks 95.50, it's going to be obviously very, very important for the precious metals market indeed. Have a look at euro dollar. We've got euro dollar pushing the top end of the range, which is not going to surprise anyone given what we're seeing in the Dixie there. But I think if we get a break of 113.80 on a closing basis, it's going to be one for the trend followers to start working positions into. Obviously, trends in FX markets, they play out much, much more quickly than we see in, say, agricultural commodities and other types of commodities. But I think this is one that a lot of people have been on their radar. We're obviously making higher lows, and can it break and close through this 113.80 level? Again, it comes down to this CPI number we've got in the session ahead. But I think the market wants to buy euros. They're saying, why do we buy euros? Europe's not anywhere near as good as an investment destination as the US, but the market is doing what it is. The price is the final arbiter of sentiment, effectively, and I think that's what we're seeing. So I think we have to respect any kind of upside break there. Do we see markets fade that? But that's something we are looking at very, very closely indeed. Now, I think in terms of gold, we're going to the gold market indeed, because what we went into 2022 with the market saying, gold's going to be a hard one, real rates are going to move higher, the Fed are going to normalize, we're going to see probably flatter curves, it's going to be bad for the gold market. But we're seeing the gold price move up, and I'm going to have a look at the technicals in a second, but I want to have a look at the options market, because while we don't offer options markets, when I look at them, it does give us a good sense of sentiment. And I want to have a look at these two lower panes. And what we're doing is we're looking at relative volatility skews, effectively. So I'm looking at the middle one. The orange line there is 1 week, what we call risk reversal. So it's 1 week put volatility minus call volatility. So when we're seeing this moving lower, it means that there's a greater demand for put options, 1 week put options in gold relative to calls. And of course, puts give you the downside protection and demand for downside. So what we're seeing here at negative 0.5, and you can see it rolling over, is people's demand for put options has been higher than what we've seen in calls. And they're saying basically if we're going to see a move down or up, it's going to be a slightly more explosive move to the downside than we're seeing in the up. And you can see that on 1 month calls, so a slightly longer duration there, you can see that it's trading at a negative skew. So again, the demand for puts has been slightly higher for 1 month options on gold. And again, it tells me that the market's just not buying this move that we're seeing in real rates. It's not buying this move that we're seeing in gold. If you have a look at the move that we saw in 10-year real rates, which we know have been such an effective tool for gold, it's been very effective and a big driver of what we've been seeing tech and also the US dollar. We saw a monster move that we saw in real rates at the start of the year, going from negative 1.14%. So these are inflation adjusted 10-year treasuries going up to negative 71 effectively, and then it's pulled back. But what I was really infused about through this move in higher rates was just how well gold held on. We didn't see this massive liquidation. We did see sellers, and I'll look at that in a second. But despite just because how punchy this move is, we would expect to see a much bigger move in the gold price than where we are. And now we've actually seen the real rates moving lower, mostly driven by higher inflation expectations as the crude price has been moving up and commodities more broadly. And gold's really had a move there. So if this was to continue to push up because the oil price is moving higher because it's such an important part of inflation expectations, then I think the dollar weakens, and I think you're going to see gold prices moving higher on the back of that. So that's something that we are watching very, very closely indeed. If I have a look at, let's go to the commodity complex. I had a look at what was going on in crude, but I think we need to have a look at more broadly about this idea of inflation expectations. Have a look at orange juice. The CTAs, the trend following funds, would be absolutely all over this one right now. Nat gas has had a nice pickup from the low. I love the shape that we're seeing in nat gas. We had this big move down. We had some consolidation. We're making higher highs. We're making a bit of a breakout through here. Now, can this take the 50-day moving average again? And can we start building on this one going forward? That's something we're looking at. Lumber, that's been pushing up again. Copper is looking like it might push the top end of the range that we can be seeing here. Again, the industrial metals working quite well. So this is this whole idea. If we are going to see a weaker dollar, and I'm not saying we're definitely going to do, a lot will depend on the CPI numbers. A weaker dollar and lower real rates, and we're back to a reflationary environment. And I think what we're seeing in gold here is we saw this move down between November and December. Now we sort of pushed the 61% retracement of that level at 1830. We saw a big sell-off there, this big outside day engulfing reversal playing through. Market sort of followed through, and we got down into these levels here, 1783. So that move that we saw in real rates, which I talked about earlier, that resulted in a move in 1831 down to 1782. So it was $50. I mean, you wouldn't want to be on the wrong side of that if you were long. You would have felt that, especially with leverage. But we're back testing these levels. So now, if we do see that breakdown in the dollar index, if we see those real rates continuing to move lower as inflation expectations move higher, then 1831 is going to be tested. We are going to see a position where people are going to be looking to see how that reacts into 1831. But if we see a close above that, then I think it's really going to accelerate the notion that we're going to see a move back into these kind of highs around 1877. So of course the trade at the moment is whether what happens into 61.8% retracement into this swing high that we saw here. That's your key level, 1831. For me, what we're seeing with this big range expansion, we're now back above these short-term moving averages, is that there is a high likelihood, in my opinion, that we're going to move back into 1830. How price reacts there, I think, obviously when you're trading breakouts, there's a whole science involved in that as well. Where we're seeing a fake out, are we going to see a breakout? There's a whole science involved in that situation. But if we see obvious signs that we're going to see a close above that level, specifically on a weekly basis, and then it kicks up, 1877 is going to be my target at the moment. So I'm leaning bullish into gold at the moment. Again, it really comes down to what happens in CPI. It comes down to what's happened in the dollar, what happens into real rates. But everything we're seeing at the moment is looking fairly comfortable for this. Let's have a look at silver. Silver's not looking perhaps as bullish, but we are seeing signs that the market is wanting to build. I certainly would be trading this one from the long side at the moment, but positioning, keep it very, very small because the CPI numbers it could be a major volatility event. We'll have to see. Let's have a look at what's happening in Aussie dollar gold. That's looking okay, but of course, it's really down to what's happening in the Aussie dollar. The euro's been a stronger currency of late, so obviously that's been weighing and keeping these moves suppressed. But again, at 1611 is the big level that you're looking for. And again, let's have a look at what's happening in US dollar versus gold versus silver. Again, we can see gold there looking to outperform. I want to bring up these charts here because I think this is an interesting one as well. Now let's have a look at the dollar's performance into and after the first month rate hike. So you can see here, this is how the dollar index tends to perform into the first rate hike since 1990. We tend to see a stronger US dollar. But typically after a rate hiking cycle starts, the dollar tends to fall. I think this is why the market's saying, well, if we're going to see the first rate hike playing through in March, perhaps statistically and seasonally, we see a situation where the dollar tends to fall. Now let's have a look at what we're seeing in terms of price. And I think this is when Jerome Powell's speaking, why the dollar is sold off, because it's fully priced. Look, we've got an 80% chance here of a rate hike in March. So, the market is firmly of the belief that we're going to see a rate hike there. So a lot of this is being priced in. Let's have a look further out. We can see 3.5 rate hikes being priced throughout the rest of this year. Obviously, with QT still very much in play, we're going to see a situation where the market is already quite rich in terms of rate hike pricing. And I think this is where the dollar bulls are really struggling at the moment. They're like, well, yeah, we've got this yield advantage. We've got rate hikes being priced in. Where are we going to get this natural flow to take place? And I think we're seeing a lot of that positioning coming out of the market. And again, that's really boosting what we're seeing in the gold price there as well. So really interesting time. We've got to keep an eye on what's happening in the dollar index here. You can see bottom end of the range. Some of these risk currencies are looking like they want to break out here. NOK yen, CAD yen looking really good, looking like it wants to break out. I think that for me is a long position. Euro dollar looking like it might want to go and test and actually break out at the top end of that range. And then ultimately, let's go back to that gold chart that we've been seeing there. And ultimately, what that means, if we are going to see the dollar index break to the downside, then this 1830 level is going to be tested. We get a close above that, and I think we start bull trending to 1877. Remember, the market does not love gold. It loves the dollar. There could be more to come. Of course, the CPI number in the session ahead is going to be very, very important indeed. So that's a whirlwind tour. I think that gives you a good oversight, hopefully, of what we're seeing in the technicals and some of the sort of multi-asset, cross-asset situations playing through. Hopefully, I'll see you next week. If you like the program, give it a like and subscribe where you can. See you next week.